we've been looking very closely at improved economic prospects in Kenya, as it's been fueling optimism about the markets, despite that not really carrying through to markets activity itself. But where exports are likely to benefit from the recovery in world economic growth, how are you positioning yourself within the agricultural space specifically?
I mean, obviously the exposure, the overall agricultural economy is quite substantial, 20 to 25% of the economy. The listed companies are actually quite few, and they mainly constitute the tea and coffee companies. And we have one, the sisal, the largest sisal producer in Africa, which is Ravi Pingo. And obviously, if you look at those, I think the ones which have attracted the most attention are probably the tea and coffee companies or related, because production has been at record levels, and international prices have remained relatively high, and even on historical terms, even if we see some slight correction, it's still generally a high price. So we've seen the companies connected with those two commodities performing relatively well.
There are a few challenges to consider, though, where meteorologists have said that rainfall during Kenya's rainy season late this year is expected to be less than usual. It's been making headlines over on that end. Has that been raising any red flags yet? Because it could well curb agricultural output moving forward.
Yes, that's true. And obviously for the export sector, I mean, for the tea and coffee, it's not, it's basically rain-fed, so that's a concern. The horticultural sector, on the other hand, that's under irrigation, so that won't make a major impact. But on overall, in terms of the economic impact, you have to look at the inflation, and obviously, if we don't have sufficient food, then we might start to see inflation creeping up, which I think is going to be a concern.
Of course, we have seen the weaker shilling doing its bit to support these players as well. What's your outlook on the local unit, where there seems to be quite a few positives at play supporting shilling strength moving forward, but the Central Bank of Kenya also seeming to jump in every time the shilling gets a bit too strong in its books?
I think the central bank is justified. I mean, if you look at the Kenyan economy, we've seen it's been under current account deficit for most of the time. And if you look at the legal requirements about the reserves that the central bank needs to have, it's supposed to have about 6 months of import cover under the East African community. And they're still a long way off, so they are probably around 3 months. So, I mean, I think it makes sense for them to actually be able to buy in opportunistically, the dollar to be able to accumulate reserves to cushion the country.
We had Kakuzi yesterday standing in the spotlight on the gainer board, increasing 7% by the close of the session. What's your view on that stock in particular, and current valuations, where it's trading at around about 84 shillings at the moment?
I think it's reasonably priced, and it's done quite well for itself. In fact, if you look at the second half, generally that's the period where it gets most of its harvest for avocados and tea. So the second half is normally stronger for the company. First half is normally weak, second half stronger, and we expect, still cautious, but we think, on a full year basis, it's still going to perform relatively well. On historical terms, it's done very well over the last 2 years.
In the meantime, the utilities also stealing some attention, both KPLC and KenGen. Of course, we do expect these companies to come out with results for the year ended June. What are some of your expectations on the KenGen front?
I think KenGen is now getting a much more attractive tariff. The exchange losses attributed to the yen-denominated loans and any other foreign exchange loans now are being passed on to the consumer through an exchange adjustment on the power bills. So obviously that's going to be attractive for KenGen. Obviously they have a lot of capex that they need to put into the grid. So in terms of dividends, you have to be cautious about the level that they're actually going to pay. So and you have KPLC on the other hand, which is also looking at share capital restructuring, restructuring its balance sheet, the preference shares. So, but in terms of earnings, I think they're also going to do quite well, and they're probably better positioned in terms of dividend payment.
Of course, KPLC looking to hive off a 19% stake in the company, amounting to further privatization for the company. Eric,